So dear friends, we are in MCOM third semester corporate tax management subject. We are in first unit. Before moving to today's topic, we will just go through whatever topics are over, just we will examine them. Significance of corporate taxation. Introduction part I mentioned, taxes are of two types, direct tax, indirect tax. The difference I made it clear to you. Significance of corporate taxation I explained. Concepts and definitions of corporate income tax, that is SSC and SSC in a default, previous year, assessment year, residential status of company, incidence of tax. So all these are over. So types of companies for tax purpose, in the previous class I just introduced the concept. What are the different types of companies as per the income tax law I mentioned. Today we will examine that topic. We will go deep into the topic, the division of companies, with the various companies, what are they? We will check them once. Okay, so these are the different types of companies. As per Income Tax Act, first one is company. Second one is a company in which the public are substantially interested. And widely held company, closely held company, Indian company, domestic company, foreign company, investment company, and residence company. This many types of companies are there as per Indian Income Tax Act. Okay, we will examine all of them. We will go through all of them. See, as per Companies Act section 2 of 17, a company means, you can see any Indian company. It may be any Indian company or any body corporate incorporated by or under the laws of a country outside India. So if a company is established even outside India under the laws of a country outside India, that is also deemed to be a company. Any institution, association or body which was assessed as a company for any assessment year under the Income Tax Act 1922. Prior to 1961, certain income tax acts were made during the British period. So one such act was Income Tax Act 1922. So any institution or association or body which was assessed as a company means various kinds of assessees, that is individual, Hindu undivided family, cooperative society, likewise various assessees are there. So as per the Income Tax Act 1922, it may be any institution or any association or body which was deemed as a company, which was assessed as a company for any assessment year under the Income Tax Act 1922 or was assessed under this act as a company for any assessment year commencing on or before 1/4/1970. So as per this act, any institution, any body of persons, any association till 1970 which was assessed as a company is deemed to be a company under Income Tax Act. Not only that, any institution, association or body, whether incorporated or not, means whether registered or not, and whether Indian or non-Indian, whether it may be a domestic company or a foreign company, which is declared by general or special order of CBDT. What is CBDT? CBDT means Central Board of Direct Taxes. Central Board of Direct Taxes. CBDT means Central Board of Direct Taxes. This you have to remember. The expansion of CBDT, Central Board of Direct Taxes. So even if any association or institution or body, whether incorporated means whether registered or not, whether it is an Indian company or not, whether it is an association or body which belongs to India or foreign, and which is declared by a general or special order of CBDT. So if any order comes from CBDT, that is Central Board of Direct Taxes, stating that an association, an institution or a body is a company, means that will be deemed as a company. If there is an order to that effect from CBDT, that organization will be deemed to be a company, will be considered as a company. So this is what you mean by saying company as per Indian Income Tax Act. Now, second categorization is a company in which the public are substantially interested. This is under section 2 of 18. What is substantially interested? Means a company owned by government or Reserve Bank of India. So you know the Reserve Bank of India, which was established in 1935, which was nationalized in 1949, is the king of all banks, is the ruler of all banks in our country. So a company owned by Reserve Bank of India or a company owned by government is known as a company in which the public are substantially interested. Substantially means greatly. To a great effect, public are interested, because if any bad thing happens to a government company or a company owned by RBI of India, then it will be bad to the entire country. So that is why a company owned by government or a Reserve Bank of India is considered as a company in which public are substantially interested. And second point is a company having government participation, that is a company in which not less than 40% of the shares are held by government or the RBI or corporation owned by RBI. So a company in which not less than 40% of the shares are held by the government. Government means here you have to imply that it may be state government or central government. So any government. Okay. So RBI or corporation owned by the RBI. In all such cases, that company is deemed to be a company in which public are substantially interested, means largely interested. Companies registered under section 25 of the Indian Companies Act 1956. So companies registered under section 25 of the Companies Act 1956 are the companies which are promoted with a special object. So under this act, Companies Act, under section 25, certain companies are established with a special purpose, like they encourage commerce, they encourage art, they encourage science, they encourage charity, or they encourage any religion. In support of any religion they work. So those companies are registered specially under section 25 of Indian Companies Act 1956, or for any other useful object, and these companies do not have profit motive. See, whenever you pronounce the word company or corporate, you think that it is going to function with a profit motive. But all these companies which are registered under section 25 of Indian Companies Act, their prime motive is service only. They work for art, they work for commerce, they work for encouragement of science, they work for encouragement to a particular charity, they work for a particular religion. Okay, all these companies are deemed to be companies in which public are substantially interested. However, if at any time these companies declare dividend, they would lose the status of a company in which the public are substantially interested. We have to remember this point. See, you know that shareholders will invest their money in a company as a token of gift to the shareholders. To their return, what the company is going to do? Company will pay them dividends. Suppose I invested 1 lakh rupee in a Reliance company. Let us take for example. Free of cost I will not invest. I want my original investment and I want any profits earned by Reliance company. My share I want to take. Those are known as dividends. So please remember, whichever company is registered under section 25 of Indian Companies Act, if the company declares dividend to the shareholders, that companies substantially held status will be cancelled. That you have to remember. They should not declare dividend. So if you are declaring dividend means what you are doing? You are working for a profit motive. It means dividend is part of profit. Whereas all these companies work without any profit motive. I hope you understood. So without profit they are working. So in order to encourage them, the government gave a tag to them. You are a company in which public are substantially interested. But if you work for profit, this tag will be removed. That you have to keep in mind. So this is what you mean by saying a company in which public are substantially interested. So not only that, a company declared by the CBDT. Similarly, suppose CBDT expansion. CBDT is an abbreviated form. I told you CBDT means Central Board of Direct Taxes. So if a company is declared by CBDT that it has a widely held reputation, public are largely interested in a particular company, it is working with a particular object, or its nature is different from ordinary companies, and its composition of members is different, it is not working with a profit motive. If CBDT certifies like that, then that company is also deemed to be a company in which public are substantially interested. So you can see it is a company without share capital. See, there is no share capital for that company. They work for a service motive, and which having regard to its object means objective, nature and composition of its membership or other relevant consideration is declared by the board to be a company in which public are substantially interested. So not only a government can declare a company as public largely interested company, but CBDT can also declare like that. So if for a company there is no share capital, the CBDT, Central Board of Direct Taxes, feels that the company is working with a service motive. In that case also, you deem that such a company as public at large are interested in that particular company. Mutual benefit finance company. Okay, this is a company in which where principal business of the business is acceptance of dividends, deposits from its members. So main business is it accepts deposits from the public, from its members, and which has been declared by the central government to be a nidhi. This word you have to remember, nidhi, or a mutual benefit society. Then such company is also deemed to be a company which is substantially having interest by the public, whose prime motive, whose prime business is collecting deposits from its members. It will not collect deposits from outsiders. From just like bank, it will not collect deposits. It will collect deposits from its own members, and it is declared by the government that it is a nidhi. It is deemed to be a nidhi, means a fund or a mutual benefit society. Mutual means for you this, for me that. So I am accepting deposit from you, and for you I am going to do this benefit. That is what we mean by saying mutual benefit. So which is declared by the government as a nidhi or a mutual benefit society. So such a company is known as a company in which public are substantially interested. So a company having cooperative society participation. What do you mean by this? It is a company in which at least 50% or more of the equity shares. You please remember, at your degree level, you must have studied about equity shares. And another shares are there. What are they? Preference shares. Equity shares and preference shares. So in a company, if more than 50% of the equity shares are held by cooperative society, the characteristic features of cooperative society you have studied at your degree level. Cooperative society works for its members. It works without a profit motive. It works for all. One for all for one. It's a motto that you all know. Okay, each member's welfare is taken care of by cooperative society. So if in a cooperative society, if more than 50% of the equity shares are held by, in a company, if more than 50% of the shares are held by a cooperative society, then such a company is deemed to be a company in which public are substantially interested. So because more than 50% of the shareholders are cooperative societies only. Cooperative society's main aim is providing service to the members of the society. So in such a case, if any bad thing happens, if a huge loss comes to that company, the cooperative society will also suffer hugely. So in order to avoid that, special status is given to such company. Okay, a public limited company. You know what is a public limited company? At your undergraduate level, you have studied about various companies: public company, private company, government company, statutory company. Like several companies you have studied. You have learnt about them. Public limited company. Three fundamental differences exist between public company and private company. You all know them. A public company, minimum 7 number of members is 7 minimum number, and maximum number is unlimited. Public limited company, in a public limited company, shareholders can transfer shares. This is second major difference between public limited company and a private limited company. In a private limited company, shareholders cannot transfer their shares, but in a public limited company, shareholders can transfer the shares. And thirdly, public limited company can issue prospectus. What is prospectus? At your degree level, you have studied. Prospectus is a document which seeks money from the public. Okay, so in case of any difficulty in the funds, a paucity of funds is there for a public limited company, it can go to public, it can collect money from the public. So that is the public limited company. So there is no limit for maximum number of members in public limited. These three are fundamental differences. No maximum limit. Prospectus can be issued by a public limited company. Private limited company cannot go to public. Thirdly, transferability of shares exists in a public limited company. Private companies cannot transfer, the shareholders cannot transfer their shares, but in a public limited company, shareholders can transfer their shares. So a public limited company, all these are known as a company in which public are substantially interested. See, public limited company I mentioned, one of the fundamental differences is unlimited number of members may be there. So unlimited means crores of persons may be there in a public limited company. So if any huge loss occurs to a public limited company, crores of people will be on the roads. Lakhs of people will lose jobs. Crores of rupees money will be wasted. So a public limited company is definitely a company in which public are substantially interested. Now coming to the third categorization, widely held company. So widely held company means, just now we have discussed, widely held company is a company in which the public are substantially interested. Okay, closely held company means it is a company in which public are not at all substantially interested, just like ordinary company. A domestic company. What is a domestic company? Under section 2 of 22A, a domestic company is an Indian company which has to pay tax as per the Indian Companies Act and as per the Indian Income Tax Act, as per the Indian Income Tax Act, which is registered in India, or which has its managers, its controlling, governing body totally located in India, and it is liable to pay tax in India on its Indian income as well as foreign income. That company is known as a domestic company. And you see, a domestic company means an Indian company or any other company which in respect of its income liable to tax under the Income Tax Act. okay, has made the prescribed arrangements for the declaration and payment within India of the dividends. So domestic company announces its income to the income tax authorities frequently, regularly, as per the norms, as per the deadlines, and it pays dividends out of such income, whatever income that is declared in that income statement. From that income only, dividend will be paid to the shareholders. So that company is known as a domestic company. Then Indian company. Now you see the difference between domestic company and Indian company. Domestic company, as per section 2 of 22A, kindly remember, it declares its dividend, it declares its income, and based on its income, it has to pay tax to the income tax authorities, and it pays dividends from that income only, and it makes certain arrangements for that. So that is a domestic company. Now Indian company means, as per the section 2 of 26, so a company which is formed and which is registered, which is formed means which is in other words established, which is established and registered under any law relating to companies. Okay, so you all know in 1956 Companies Act came into effect, and recently in the year 2013 also New Companies Act came into force. So under any of the Companies Act, if a company is established and registered, that company is known as Indian company. Okay, so a corporation established by or under a central or state or provincial act, any institution or association or body which is declared by the board to be a company. So all these corporations are known as companies. So in the case of state of Jammu and Kashmir, a company formed and registered under any law for the time being in force in that state. But now you see, recently you all know, Jammu Kashmir's special status has been revoked, has been removed. So this, I think this is eliminated now. So all the whatever laws applicable to an Indian company, the same laws are applicable to a company which is established in Jammu and Kashmir now, because recently its special status is revoked. Okay, so keep that in mind. So in the case of any of the union territories, you know, in India, states are there, union territories are there. Okay, so in the case of any of the union territories of Dadra and Nagar Haveli, Goa, Daman and Diu, Pondicherry, a company formed and registered under any law for the time being, okay, that company will be deemed as an Indian company. So a company is deemed to be an Indian company if it is registered, if it is established under any of the company's laws, that may be 1956 or 2013 or earlier British government may have established certain companies. So all those companies will be deemed as Indian companies. Okay, not only that, another important point is that the registered office or the principal office of the company is located in India. That should be there. Principal office of the company means registered office should be established in India, should be addressed in India. It should have its registered office in India only. And not only that, the management, the controlling body, governing body, the association or body, in all cases, the address should pertain to India. In such conditions, that company is known as Indian company. Okay. Now coming to a foreign company, just opposite to Indian company is foreign company. Whichever company is not Indian company or domestic company, all other companies are foreign companies. So this is under section 2 of 23A. Foreign companies means a company which is not a domestic company, means it is a company registered outside India. It may be Pakistan, it may be Sri Lanka, Australia, America, anywhere. It must have registered somewhere outside India. Then investment company. What is an investment company? See, I hope that you all know there are 5 heads of income in income tax. One is income from salary. At your degree level, you have studied this. You have done problems also. Income from salary, income from house property, and income from business or profession, that you all know. Income from business or profession. Then income from capital gains. Capital gains, income from capital gains. And lastly, income from other sources. At your degree level, you have done problems. Other sources means these are very clear. Income from salary. Please remember, our next topic is this one only. What are the various incomes that are shown in company's total income? Except the salary income, all incomes are part of company's income. Because company is not a person, it cannot work anywhere, it cannot earn salary. So except salary income, all heads will remain for company. Please, you have to remember that. So companies may have house property. Company is going to indulge in business. Company may be established for carrying out a profession. Company can enjoy capital gains. Capital gain means in the name of a company, one house you can purchase today and after 3 years you can sell it. And on that sale you can earn profits in the name of the company. Other sources of income, lottery income may be there, income in the way of in the form of dividend may be there. Several such income sources may be there, income sources may be there for a company. So investment company is a company in which majority of the income comes from whose gross total income comes from income from house property. That's all. It will not have any salary income. It will not have any business income. It will not have any capital gains or any other source income is not going to be there for that company. So investment company means a company whose gross total incomes consists mainly of income. So majority of the part income comes from house property only, and capital and income from other sources. That's all. Means what is that which is missing? Main income does not include business income or professional income. So a company in which mainly income comes from house property, capital gains and other sources income. That's all. Business and profession income is very minute, very minimum. That company is known as investment company. Then lastly, residence of a company. Under section 6 of 3, based on residential status, in our previous class also I mentioned, a company can be resident company, non-resident company. So in any previous year, in a previous class I have also discussed previous year assessment year. Okay. So a company is considered to be a resident in India if it is an Indian company in the previous year and whose place of effective management means board of directors are situated in, board is situated in India. In such a case, it is known as its residential status is considered to be resident in India. In all other such cases, it is deemed to be non-resident in India. So a non-resident means just opposite to resident in India. Means it is not an Indian company and its place of effective management in that year is not in India. In all such cases, that company will be deemed as non-resident in India. So today we have discussed about various companies under Indian Income Tax Act. Companies are divided as a company, and a company in which public are substantially interested, a company which is widely held company, closely held company, domestic company, Indian company, foreign company, investment company, and based on residential status also resident company and non-resident company. So I hope you all understood the class. Thank you very much, dear friends. Yes, I wish you a very, very happy Pongal. We will meet again in the next class. Thank you very much, dear friends.